Hello, everyone. Good afternoon. Genius Tax Advisory presents One Big Beautiful Tax Talk. I am Yesenia Reynoso, your moderator and host for today's panel discussion. I am the Director of Strategic Communications and Growth here at Genius Tax Advisory, and we are also very excited to be joining you here on Zoom to discuss one of the most consequential bills in recent memory, which is the One Big Beautiful Tax Bill. And so for the next hour, we are all here to discuss big changes and how to improve your overall tax strategy. And so this particular tax talk is the second one in our series, Tax Talk. And this exclusive 1-hour webinar is going to break down the newly passed tax legislation and how it is set to reshape the financial game for business owners, investors, CFOs, CEOs, financial professionals, and net worth individuals alike. So if you're wondering what's in the bill itself, will my tax liability change, and what should I do before year-end business tax deadlines and preparations for 2026, then this is the place where you need to be. And we are all so incredibly excited to have such an informative and insightful conversation. So before we move to the panel, and as well as a couple of quick housekeeping notes, I would like to hand over the mic to our President and CEO, Krishna Mohan, to say a few words. Krishna?
Hello, everyone. My name is Krishna. I'm the President and CEO of Genius Tax Advisory. Thank you for the opportunity for us to share incredible insights. We have amazing expert team on this call. Feel free to ask questions, make it interactive, and get value from this call. We want to bring you up to speed and updated on the tax laws and year-end preparation. And I think we will also offer a complimentary strategy session. Yesenia would be able to give you the coordinates for that, take advantage of that, and I wish you a wonderful next 1-hour session here. Thank you, Yesenia.
Thank you, Krishna. And that will be the perfect segue to enter into the housekeeping notes. And so as our CEO has mentioned, we are offering a free complimentary discovery call for attendees who are interested in learning more about our tax advisory services, activities, initiatives, and so much more. If you're looking for ways to save financially and need that strategic input, do not hesitate and fill out the form, and a member of the GTA team will be advising you. Also, if you have not done so yet, please follow us on LinkedIn, and as well subscribe to our company quarterly newsletter, The Genius Vision, which is on LinkedIn. Our next edition is coming up in a few weeks in mid-November, so this is your opportunity to have a better understanding as to the updates, the news, announcements, and everything in between surrounding Genius Visionary Inc., Genius Tax Advisory, and the rest of our portfolio companies. Now that we are done with the general housekeeping notes, we will now officially move on to the actual panel itself. Before I hand the mic over to our 4 amazing panelists, I would like for everyone to be aware of the actual structure of the programming. We're going to be diving into 4 sections / themes for the One Big Beautiful Tax Talk. Each section will take no more than 10 minutes, and it will be spearheaded by one of our lead panelists. Once they complete and offer their input, other members of the panelists are more than welcome to chime in and add on to the section panelists' answers. Once we are completed with the section, then we will move on to the next one. And so with that in mind, I will now officially hand the mic over to our panelists for them to offer their introductions. And so, fellow panelists, please say your name, your title, your organization, and a quick tax strategy or tidbit as to what and what people can save or prepare for in 2026. And we will start off with the person who is to the right of my screen. We'll start with John McFarland. John, take it away.
Thank you. So I'm John McFarland with Cost Segregation Services, Inc. We're located out of Baton Rouge. I am in Ohio, and the weather is lousy here. Uh, but my one take would be to understand that it seems like that the 25, 26 year will be the most tax advantaged years for real estate owners in decades. That's big.
Thank you, John. Great tidbit there. Next up, we have Kristen Dickens. Chris, Kristen?
Hi, how are you guys? I'm Kristen Dickens. I represent Dickens and Associates as well as Jane Accounting. I'm a managing partner in both firms. Um, I handle a lot of legal tax strategy and compliance in my background, and I would definitely state that the tidbit I would recommend the most would be predominantly document everything. The IRS is becoming light years ahead with where they were 5 years ago. So conducting pre-audits and compliance reviews are going to be your best bet, especially when we're dealing with planning and protection and compliance with this OBBA.
Amazing tidbit. Thank you, Kristen. And now we move on to our next panelist, which will be Sai Pure Siri. Slide, please take it away.
Yep, thanks, Yesenia. Nice to be with everyone. I'm Sly Passeri. I'm with Access Capital Group. We are a distributor of various private equity investments, including a charitable donation strategy that I'll be talking about in a little bit. And really, just my piece of advice would be try to learn, try to see what is out there, because certainly there are a lot of strategies that most of us are probably unfamiliar with that can help you with your taxes. And we'll try to highlight some of those for you today.
Thank you, Sly. That was a great insight you offer there. And finally, our final panelist, which will be Sham Arayo. Sham, please take it away.
Sure. Hi, everybody. My name is Shyam Rao. I'm a CPA. Been in practice for 28 years. My title is tax advisor with Genius Tax Advisory. My one tidbit would be if for 2025 we take advantage of the bonus depreciation, which is huge. I'll leave it at that, and I'll be sharing some other strategies also throughout the program.
Offering a teaser, huh, Shy?
Yes.
I like that. All right. Well, fellow panelists, it is now time for us to dive into the panel discussion itself, and we will begin with our first section theme, cost segregation and strategic tax planning for real estate and investors. And our core section panelist will be John McFarland from CSSI. So, John, this particular section, the objective of it is to demystify cost segregation and identify 2025 and 2026 opportunities. So my first question to you is, how can cost segregation help real estate owners maximize deductions under the new bill?
Anybody that owns commercial real estate or residential rental real estate has the opportunity to separate out in their depreciation schedule what is personal property and what is the actual building itself. The structure of the building, the foundation, the roofs, the walls, outside walls. And in doing so, we can then take those depreciable assets, the 5-year, 15-year depreciable assets, and accelerate them. By accelerating, I mean now you can take it in year one. It's 100% bonus is now available, so it's available in year one, and that's a big, huge deal. It was set to go down to 40% and got rescued and at the last minute, and the 100% seems to be going to be permanent for the next several years. So the big advantage for an individual owning is to increase, what most want to do is increase cash flow. This is a huge way to do it. The ability to get a windfall in the first year, anywhere from 60 to 100,000 on $1 million building. And we go anywhere from about $500,000 cost basis up. We've done as high as a $1.5 billion portfolio. So this is the year that everybody has a great opportunity. If you've not done cost segregation and you have held the building for several years, you can still do it. There's no amending of back taxes. There's no adjustments to be made. There is a form that has to be filled out. It's called IRS Form 3115. We assist in doing that and getting it to the CPA if that's the way they want it. And that's it. You can go back. I've gone back as far as 20 years on a 39-year depreciable asset and saved them a lot of money. So don't think that if you have one and you've owned it for several years, you can't do this. And if it falls within a bonus period, so this year is 100%. Last year was 60%. If you bought it last year, you can still declare the bonus. We just have to take the depreciation you already filed and to go back to, so it goes on back to where it used to be at 100%. So those opportunities, don't think that it has to be brand new. It has, condition plays a lot in it, yes, but it doesn't have to be brand new. I probably do 80% same year purchase of my business. And everything from portfolios to single fourplex, rental duplex, short-term rentals, vacation rentals. Did I hit on? Go ahead.
That is quite fascinating. And do you have anything else that you would like to follow up before we move to our next question?
Go ahead.
Okay, you're ready to go. I like that. So moving on to our next question, John, what types of investors see the largest return of investment, or ROI for short, from accelerated depreciation studies?
Interesting question. There is, everybody has a pretty good ROI. Basically anywhere from 10 to 1 up. The type that have higher ROIs are projects that are primarily like apartment buildings or offices that have a lot of 5-year assets in them. And they have those because every apartment building has cupboards, toilets, flooring, all those types of things. And every office has cubicles built in, lighting, all these things all follow. So those two market segments have basically the best amount of return. The others, probably the lesser ones would be something like a warehouse, because you don't have anything in the biggest amount of the warehouse. You got 2,400 square foot of office in the front. You've got the rest of it in the back, but there's not a whole lot there. It's cranes and garage doors and those types of things. So that would probably be the least. It's still good return for them, but that would probably be the least.
That's quite insightful, John. And my final question to wrap up this section will be, how can businesses integrate cost segregation into broader strategic planning for 2026 compliance?
One of the quick ways to do it is when you're working with your CPAs, and we have CPAs on here for your tax planning, is to, if you have real estate and you've not had cost segregation done, we do a preliminary predictive analysis at no cost and no obligation. So you take that to your CPA then, and you start the conversation. Does this make sense for me? Is it a tax advantage for me to do this now this year? And if I don't do it this year, what am I missing out on? So you plan ahead to look. Once we start a study, it only takes about 2 weeks to 4 weeks to finish the study. And we're able to get you a final number then. We give an estimate of what we feel will be the low number, a conservative estimate, and we have a higher estimate, but it's even on the conservative side. So, by planning ahead with your financial planner, do some legwork on it, take those materials to them. He or she will go over them with you and then let you know ask the right questions and make the determination. If you can't use it all, don't let that deter you, because the remainder just rolls to the next year. So now you got more in the next year. So you don't necessarily have to take it all, but it just depends on what you need and what the individual tax issue is.
Quickly want to follow up on that, John, because obviously everybody's planning ahead for 2026, but there always are some individuals who are looking like way ahead, like 5 years past their time. What do you forecast in seeing how cost segregation in correlation to this bill, how will it continue to cultivate?
Um, if you take 100% bonus depreciation, that means you used all the 100% of the 5-year, 15-year. What you have left for the life of your ownership is either 39-year straight line depreciation or 27 and a half for residential straight line depreciation. So you're getting 1/27th or 1/39th a year. So it doesn't give you much boost going down the road. You're still getting depreciation. The big equation is running out the time value of money. You have a windfall of 150,000. I've got one right now. He's got a windfall of $2.1 million to utilize. And do you want that now? It's like the lottery. Do you want it, or do you want to take it in monthly amounts at 1/39th a year? I'll take the full amount. So that's the advantages now, and that time value money, when you work with your financial advisors, can help you invest it, buy new buildings, pay for college for your kids or grandkids, any number of things.
Thank you, John. That was truly an amazing session, and one that, in my opinion, everyone can definitely learn and implement some core strategies as they prepare to move ahead with their tax planning for 2026. And so, before we move on to our next section, does anybody from our panel would like to offer additional input?
In my opinion, John hit it on the head. That's why I was nodding about the 3115 form, and these forms that he's talking about and the practices that he's discussing are really going to impact a lot of real estate. And personally, Dickens and Jane have a lot of real estate clients. So, his strategies are really benefiting also my clients as well, that, anyone in real estate should be using these different practices that are going on and that he's spoken about.
Thank you so very much. And that is the icing on the cake on our first section of our panel discussion. And now we move on to section number 2, where we're going to be focusing now on the legal, compliance, and IRS enforcement updates surrounding the One Big Beautiful Bill. And our core section panelist is Kristen Dickens of Dickens Associates LLP. So, Kristen, it is now your turn to grab the mic and offer your insights surrounding the legal aspects of this legislation. And so the objective will be to clarify subtle shifts in IRS enforcement and compliance expectations. And so we're going to kick it off with our first question. What are the key compliance areas business owners should prepare for under the new legislation?
Okay, so this is going to be a doozy. So we're going to be there's several big compliance shifts that business owners are going to need to start preparing at this point. So number one is going to be capital spending and depreciation, which John definitely did discuss about. 100% bonus depreciation, as he spoke about, is back, and for qualified, property that's being placed in service, that Section 179 expense limits are higher too. So there's a trap, right? There's a trap with this. So we need to make sure we document everything. That's really the big compliance here. Documentation. You need clear proof of when the asset was placed in, and this service, the business use percentage, and supporting invoices including in that. So that's really important. 2, business interest deductions. The OBA has reinstated EBITDA. So this gives us, base limitation there. The firms with debt or related, property loans must recalculate these limits and need to track those interest allocations. carefully, especially partnerships and S corps. It's really, really important that we do that. Three, payroll and reporting changes. These are new employee deductions that are happening, like overtime and car loan interest, and that 1099 threshold now jumps to 2000. So that means new payroll configurations become cleaner classifications for bookkeeping situations between employees and contractors, and we must make sure we're more precise on a year-end reporting. Our credits and benefits are changing. So paid family medical leave are now wholly permanent. So owners need to make sure there's policy documentation and eligibility tracking with these. And then the last and not least thing is entity and timing strategy. This is really, really important. These rules impact when you buy, how you structure, and the type of entity you're using, right? So when you're revising your 2025 estimated payments and your entity setups early, instead of waiting until year end, which is going to be way too late. You're going to want to handle and take this by the bull of the horns and do this early on instead of the late situations that most of us are tax strategizing in November. We kind of want to try to be doing this in February or March at this point. So my clear takeaway here is compliance this year is less about knowing the rule and more about proving you follow the rule.
That is, that is a great point that you made there, and I think one that that everyone should be aware of, especially with the recent regulations and shifts in policy that we all need to take account. And so that is a great way to segue into our next question, which is how is the IRS shifting its enforcement focus, and what does that mean for high income earners?
Well, that's actually a really, really good question. As a former Internal Revenue Service worker, I can honestly attest that this is going to be highly more enforcement modernized phasing. So they're going to they're going to rebuild staffing. Granted, yes, we have the government shutdown, but they're in process of rebuilding their staffing and are using AI and data analytics to select our audits now. So this is going to impact us a lot more than we're usually normally, okay, it's this, and the computer picks it. It's now AI and data analytics. That's going to be who's in the crosshairs. That's high income individuals. So anyone with high income or ultra high income, those making over $1 million, large complex partnerships, the audit rate for 10 million plus earners is approaching about 9%. What are they targeting? Digital assets reporting, foreign accounts. This is really important to understand what they're targeting. Basis shifting, ERC claims, aggressive business losses. They're matching data from your banks, exchanges, and payroll providers in actual real time. So that's scary, So you need to make sure that as a business owner or high net individual, you're going to expect more correspondence audits. You're going to expect more document requests. Hence why I keep saying document, document, document. It's really, really important. The IRS is moving from the did you file concept to can you substantiate every line. Your steps as business owners and ultra high net worth, you need to have that audit readiness review, like I was talking about in my earlier recommendation for my tidbit. Especially if you have multiple entities, you are dealing with foreign interest and you have extremely large deductions. Being proactive, this is going to cost less than being reactive once the notices arrive. Okay. The takeaway at this point is that most technological capabilities of the IRS we've seen were subpar. This year, it is 5 steps ahead.
And it's being modernized, Kristen, with the fact
Yes.
with emergence of artificial intelligence, which we all know across all industries is changing the ways to how we do business, even from the day-to-day operations to the much more advanced strategic insights and how documentation regulation now is going to be utilized. And so it leads us right into our third question, which talks about best practices, especially now with these new regulations, artificial intelligence, and a whole lot of other key technologies, whether it's databases or tools that are coming into the legal side of taxation. What are the best practices for documenting deductions and protecting against audit risk heading into 2026 and beyond?
So I'm going to repeat myself. Documentation is going to be your shield. You need to protect yourself with a massive paper trail. So every deduction needs three things: proof of payment, business purpose, and timing. Keeping digital copies is going to be your, like, receipts, invoices, payroll summaries, organized by category. For assets, we need to record placed in service dates. We need, for employees, keep timesheets and W-2s. And for contractors, really make sure that their 1099s and agreements are also digitalized and in a file. These are going to help when we create internal review points. So when we do, and highly recommended, quarterly audits, and they're considered like mini audits, but it's really imperative that we do this. We want to check large and unusual deductions, internally. The IRS is going to automatically do it, so why not let us do it ourselves, right? You want to make sure that any new credits you've utilized are accurate and the entity transactions are. You want to catch the errors before the IRS does. It's really important that you do this. You need to, a lot of people hate the word conservative and defensible, but we need to do it. We need to, especially in the first year, we need to make sure our positions feel gray, and we prepare short support memos citing the code sections and reasoning, and that the CPAs are doing that for us when they're handling our account. So like at Dickens or Jane, we do that already just in preparation. So we document, and we make sure that everything is addressed. When we're integrating the tax with operations, we don't want to let deductions drive the business decision. We want to make sure purchases and expenses are aligned with the operational needs and timing. It strengthens your business purpose, and it really moves your business in the right direction, especially in the IRS's eyes. Make sure you have retention and backups. Make sure your records are at least 6 years, longer for credits. I'd say about maybe 10 for credits and partnerships and foreign filings, and store them securely with dates and stamps. Different CRM softwares have this ability. You have data management profiles. IT can do it for you as well. So it really utilizes the resources that we have, or you have as companies, and especially your CPA firms as well, whomever you guys are using, because that's really going to benefit you as well to keep this data tracking.
Thank you, Kristen, for that insightful, for all of that insightful information, especially since it is, keeping tabs with the legal side of taxation is really important for everybody to, to not only obtain, but also figure out as to how they need to be well aware when they do eventually initiate their strategic planning. So thank you so very much for everything in section 2. And so unless if anybody from our panelists would like to quickly chime in, we're going to immediately transition onto section number 3, which is charitable donation strategy and the act's impact.
Okay.
Yes, John,
I could real quick. Can you hear me okay? Because my camera's jerky. You can hear me okay? Yeah.
Yeah.
Okay, Kristen, you did a great job, and it flowed over into, we deal with the documentation all the time, especially if somebody's declaring themselves a real estate professional and they're running their own rentals. And it's all about document everything you can possibly do, take photos, properties, whatever, because that's going to protect you in an audit. Go ahead.
I completely agree. I feel like documentation is our strategy at this point, especially with the OBBA. We want to make sure documentation is strategy.
Yeah.
Fantastic. John, anything else before we move on?
Nope.
Well, I'm sure we'll definitely continue this conversation once we reach the live Q&A. And I do also have another topic for you, Kristen, that I think our audience will be interested, but we'll get to that once we reach the Q&A. And so right now, I am going to hand the mic over to our next core section speaker, Sly Persiri of the Access Capital Group, where he is going to be focusing on the charitable donation strategy and the Act's impact. The objective of this section is to showcase charitable giving strategies for year-end planning and leverage under the Act. And so, Sly, I am going to start providing you with our first question. How does the current Act influence charitable donation strategies for high-income earners?
Yeah, thank you. So the act does maintain the ability to claim a fair market value for charitable deductions, but what it does is create a floor or a threshold that needs to be reached before any charitable deductions can be taken. So this would be, it's actually a 0.5% floor. So that means, if I'm someone making $1 million, I need to have charitable deductions of at least $5,000 before I can start claiming any. So it is a small reduction. As well, there is also going to be a reduction just based on either the investor's AGI or the amount of deduction that they're claiming. All told, we do expect these to be nominal, even though it does reduce the benefit. For example, again, going back to $1 million income earner, they're probably expecting a charitable deduction reduction of maybe 13 or 14,000 on a, let's say, $500,000 reduction. So it is a slight reduction, but the good news is that it doesn't go into effect until next year. So for any 2026 and going forward deductions.
Charitable giving, it's a very interesting and intriguing topic, especially given the direction where it's heading from a taxation standpoint, Sly. And I'm very curious to hear from you about non-cash charitable donations because I'm certain that there are many people who do offer charitable donations through that method, and so. Our second question is, what makes a non-cash charitable donation so powerful in reducing AGI, not only for 2025, but beyond that?
Yeah, and actually here in the US, we're one of the most giving nations in the world. Last year, Americans donated over $500 million worth of stuff to qualified organizations. Of course, everyone has their reasons for it. Many of us want to benefit and support a good cause or a good mission. But I think a lot of it also has to do with the fact that the IRS does give an incentive to giving to charities, and that is that you can deduct the fair market value of what you donate against your AGI. And there's different limitations to it, but when we talk about non-cash donations, which is a strategy that we offer through Access Capital Group, you can take up to a 50% deduction. So that's 50. So imagine the savings on your taxes if you're only paying or you're only being taxed on half of your AGI. And this is a strategy utilizing intangible personal property. And we get the added benefit of being able to acquire these goods at a discounted price. And when you donate, the IRS allows you to take the fair market value at the time of donation. And that target discount that we're looking for, that we've negotiated with different companies that are selling a product, is 1/5 of their retail cost. So what that means is, we're buying something here at a fifth of the retail cost. When we make the donation, we get to claim the fair market value or what that retail cost is. And just to give you an example, on $1 million income earner, if they're to spend 100,000 into the fund, they're looking to get a $500,000 charitable deduction. And depending on what state you're in, that'll probably lower your tax bill by anywhere from 200 to maybe 230 and 240,000.
Wow.
And certainly I'll add and I'll echo what the other panelists have said, what Kristen has said, talking about documentation. We know that that is extremely important. The group that we work with, which is a team of tax experts that is offering this, they've been doing this 9 years now, and they have everything provided for you turnkey from a tax documentation standpoint. So all investors do get a K1, a Form 8283. These are required in your filings. You also get a copy of the qualified appraisal and a copy of the donation acceptance letter from that qualified charity.
Wow, I'm blown away by what I'm hearing here, and I'm sure our audience echoes those sentiments, Sly. I didn't realize that there were so many important data surrounding charitable donations, whether it's from non-cash or regular or any other aspect of it. And so, as we move towards 2026, many of us start to think about strategies as to how we can implement those. And so wrapping up this section, what should taxpayers consider before implementing these types of strategies as we approach next year?
Yeah, I think knowing that going into 2026, there's going to be a reduction on the benefit that you can get from a charitable donation, it's wise to think about what are some of the big ticket items that you may be considering that would create a taxable event. So, for example, like an asset sale, or what I have a lot of investors looking at right now is a Roth conversion. So taking money from a pre-tax account like a traditional IRA, converting that into a Roth IRA, which would then put them in a tax-free account. All that future growth, future income is all tax-free. The downside of this, of course, is that when you do that conversion, you create a taxable event for yourself. So we can offset that and minimize that tax bill by utilizing a charitable donation strategy. And if we do that this year, we get the maximum benefit.
Wow. Once again, Sly, that is so incredibly helpful. And before I we move on to our final section, does anybody from our fellow panelists would like to add some additional input? Yes,
Absolutely.
yes. Go.
Um, w- w- I would also recommend, if we're high net worth, to look at DAPs and charitable remainder trusts as strategies as well. This is going to build, riffing off of Sly's charity donations. These are going to also benefit you guys as well. And if anyone doesn't know what a DAF is, it's a donor advised funds. Charitable remainder funds are CRUTs. They're a trust, really. They help as well, and this is going to just more segue into what Sly is discussing. So I'd definitely think of those as well. GST, gift taxing, that went up for 2025. So it's going to also benefit you guys too.
Thank you so much, Kristen. That was absolutely a must-have a tip, and we really appreciate that. Sly, is there anything else from the charitable donations standpoint that you would like to offer before we move on to our final section?
No, if you're thinking about doing this, just the time is of the essence. So the organization that we work with does close everything by that first week of December. That gives them time to close the investment, and more importantly, make sure that donation is made to that charity by December 31st, and it's recorded, and we get that acceptance letter from the charity.
Thank you, Sly. What a way to wrap up this section, and definitely something, especially like if you work in the nonprofit space, this type of insight is so incredibly important as you develop your own budgets, fundraising initiatives, and strategies as you plan ahead, not only for next year but beyond that. So thank you, Sly, for that fantastic section conversation. And now we move on to our final section, which is going to put the focus on tax strategy updates and year-end moves for 2025, 2026, and beyond. And so I am going to hand the mic over to our final core section panelist, our very own Sham Rao of Genius Tax Advisory. And so, Sham, I now give the mic over to you, where the objective is going to be about presenting actionable tax moves for not only Q4, but for years beyond that. And so, my first question for you is, what are the most effective deduction and credit strategies businesses can still implement this year?
Sure, there are plenty. I'm gonna do my best to explain as much as possible. There is a lot, but most business owners, treat Q4 like, the finish line. Smart ones treat it like the starting gate. So this year isn't over yet. We still have 62 days. That's enough time to implement strategies that could reduce your 2025 tax bill by a lot, by thousands of dollars, and build the foundation for even better results in 26. So some of the strategies are like for S corporation owners, optimizing your salary versus your distribution mix. And what I mean by that is the IRS requires S corp owners to pay themselves a reasonable salary, but many business owners miss this mark. I've been doing this for years and I still come across this issue. Pay yourself too little and you invite like an audit risk, pay yourself too much, you're losing money unnecessarily to payroll taxes. So there's more at stake than just a payroll tax. Your qualified business income deduction is also impacted by how you pay yourself. Paying too much salary reduces your potential 20% QBI deduction, a missed opportunity for significant tax savings. If you're underpaying yourself, now is the time to adjust to meet the IRS standards and protect yourself from scrutiny. If you're overpaying, Q4 is your window to course correct going forward and lock in a more strategic approach for 2026. So you should really set up some time with Genius Tax Advisory to go over and review your benchmarks and execute some changes, payroll changes, and things like that. And
Fantastic.
then, Christian talked about this a lot. Documenting your reasonable compensation methodology documentation is very critical. If the IRS ever questions your salary level, you need to document showing how you determined it was reasonable. This isn't urgent, but Q4 is a good time to create this record.
Kristen, you
Yep.
might have started something with the documentation piece. I just wanted.
Compliance, I'm giving you compliance.
I mean, I have to tip my cap to you because something so traditional is still so relevant and timely today, and and it's something that all of us should should really take into account. Just how incredibly important it is that we need to document absolutely everything.
It's gonna save your lives. Documentation is, it's like I said, is the strategy. It's not, it's not the rules, it's the strategy that's going to save you right now.
Right.
Yep, and I could. We all attest to that. So, Shy, we now move on from deductions and strategies now to retirement. The one topic that everybody is very much invested in figuring out ways as to how they could better position themselves during their golden years. And so, our next question is: how can retirement contributions and entity structure changes influence next year's tax bill?
Sure. First, I'll hit on the retirement contributions, then I can talk a little bit about the entity structure changes. So retirement plan contributions can reduce your taxable income and defer taxes depending on the type of account and your income level. So traditional pre-tax contributions affect lower your adjustable gross income and taxable income in 2026. So for example, your 401k and your 403bs, you can contribute up to $23,000 in 2025. Plus they have I think it's a $7,500 catch-up contribution if you're age 50 plus. And 2026 limits likely adjusted upwards, I would think. And there's also the traditional IRA, deductions of up to $7,000, $8,000 if you're 50 plus, subject to income phase outs. So the tax impact is, you get an immediate deduction, reducing 2026 taxes owed. Withdrawals and retirements are taxed as ordinary income. And there's also the Roth, which is the after-tax contributions. The effect is no upfront deduction, but tax-free withdrawals later. And also a strategy note, if individual tax rates rise after 2025, as currently scheduled, paying tax now at a lower rate may be more beneficial to you. And then the last point I want to focus on is the SEP IRA, Simple IRA, and the Solo 401k for business owners. The contributions can be much higher depending on business profit. These reduced taxable business income affecting both income and self-employment tax. So that's what I have for you guys on the retirement contribution side.
Very nice. And what about entity structure? Is there is there any tidbits that you would like to offer from that standpoint?
Sure. So if you own a business, right, changing your entity structure can shift how income is taxed. For example, like if you're a sole proprietor, you have an S corporation, an LLC, or a C corp. So the key 2026 considerations, because many Tax Cuts and Jobs Act provisions are set to sunset after 2025, your entity choice could matter much more. So, for example, the entity type, right, like sole proprietorship, pass-through entities like LLCs, S corps, and partnerships, the 2025 tax treatment, you're eligible for up to 20% qualified business income deductions, the QBI, which is a Section 199A. And the 2026 potential change is the QBI deduction expires after 2025 unless extended, effective tax rate may rise. For a C Corp, flat 21% corporate tax rate, the rate could increase to 28% under prior proposals. S Corp, obviously, we talked about the reasonable salary and the dividends aspect. The 2025 tax treatment, salary taxed as wages, remaining profit as a pass-through on your K-1 to your personal income tax return. 2026 potential change could still be beneficial if QBI deduction ends, but payroll and compliance matter. And the last one is the LLCs taxed as a partnership. The 2025 tax treatment is pass-through income. It's flexible, but 2026 potential change may lose QBI deduction, increasing personal tax burden. So if you're currently a sole proprietor using QBI deduction, you may owe significantly more in 2026 when that deduction disappears, unless you change structure or adjust compensation strategy.
Great way to sum it all up, Shai. And now we're going to dive into the world of foreshadowing and looking ahead to not only 2026 but beyond. And so, our final question to wrap up section 4 is what's on the horizon for 2026 and how should attendees start preparing now?
Yeah, so there are some key changes to watch. Some are already set. Others depend on, what Congress does and further guidance. So there are some inflation adjustments for 2026. Standard deductions for filers who file singles, 16,100. Married filing jointly increases to 32,200. Alternative minimum tax, or they call it AMT exemptions, is 90,100 for singles and 140,200 for married filing jointly. And long-term capital gains brackets and estate and gift tax exclusion also shift upwards via inflation indexing. And then business changes for businesses, especially, I don't know if this this is a requirement. This is for like multinational or export oriented. There are changes in the international tax rules, which I'm not going to cover here. So how should you start preparing with these changes in view? There's a to-do list: review and model your taxable income for 2026. Estimate your 2026 income now, which means your salary, your business income pass-throughs, your investment gains, etc. Run scenarios. What if tax rates increase? What if large deductions shrink? Identify whether you can shift income or deductions logically into 2025 or defer into 2026, depending on which side of the line is more favorable to you. And then, basically your business entity structure review. If you own a business or get income through a pass-through entity, revisit whether your structure is still optimal under potential 2026 changes. Meet with your tax accountant, your CPA, or us, Genius Tax Advisor. We can help you further in all of this.
All right. Thank you, Shai. That is That is a phenomenal way for us to put the bow on the panel section of our webinar. And does anybody from our fellow panelists would like to add additional insight to Sham's thoughts?
I think you said it very well. I'm gonna, be very honest. I think that, everything all of us have put out on the table is going to benefit anyone watching this one way or another. It's going to help them, understand the transitioning that's going on.
I would throw in that is great presentation, Shai. Um, I'm not a tax person completely, so I've learned a couple new things there. But it's just to anybody out there, don't wait to the last minute to think that you're going to go in and get everything done on time. You're going to end up filing extensions, and then when you file the extension in April, you're going to end up not doing anything and having to file another, you're going to be running crazy in September. It takes time to do a cost segregation study. It takes time for the CPA to analyze anything that you're dealing with. Whatever it is there, it takes time. They've got to be able to have time to review it. So I can't tell you how many times it's been, can I get this in time? You've had it for 9 months. It shouldn't have been that.
Jolting of firms.
Yeah, that's just it. That's just a suggestion to people.
I'd like to add one quick thing. I'd like to follow up on what John said.
Yes, feel free.
Yeah, the only strategy that I think that can be, correct me if I'm wrong, Kristen or John, is the cost segregation study. If you file an extension, you still have time to get the cost seg done and file it by the extension deadline. Is that accurate?
If I understand you, so let's put it in, is this a property bought in 2025?
Yeah, if you
And
bought it in 2025 and you didn't do anything until April, you file an extension.
yeah, you can still use it. Yes.
Yeah, that's about the only strategy that I know
Yeah.
of
Yeah.
that
But
you can
we've
do
had
it.
we've had instances where I had one just recently owned it for 2 years, never took depreciation. So
Yeah.
at that point, we have to make up what the depreciation should have been and do a 3115 form in order
Mhm.
to change it. And so, yeah, there's ways to, just like with, business. I've got tax experts behind us that are tax experts on cost segregation and R&D. So yeah, it is. That's a good question. I hadn't quite thought about that before, but yeah, it happens that way.
Yeah, the reason I say that I did one this year in 2024 where the gentleman hadn't done a cost segregation study, and it was after the extension when the
Oh.
analysis was still going on. So
Hmm.
I would recommend our anyone watching be proactive, not reactive, like I've said, document. I would also recommend setting up that Q1 strategy meeting
Mm.
immediately to align any goals, expansions, acquisitions, estate moves, cash flow changes, as well as real estate issues. And this is me as a compliance person. You want to make sure you are proactive. You want to handle it immediately before it gets way out of your hands. And I believe John has said that already. And I'm riffing off more on that you, especially with cost segregation and real estate, you really want to make sure your precision. You want to make sure your tax specialists know what they're talking about. And if you don't, have every right to get a second chance opinion too. Contact Genius Tax. You can contact one of our firms for specialties as well, and that's going to help you in getting the answers you're going to need to.
I'm loving the synergy here. It's everything that everybody has been saying is absolutely spectacular, and we could have this conversation for hours because there's just so much. It's an overwhelming wealth of information that so many people can really utilize. And these are the types of questions and input that people need as they figure out their strategies heading into 2026 and beyond. And I know we are literally at 3 minutes before this webinar comes to an end. And so let's do this one question. So everybody, it's a round robin. Everybody answer, and then I will wrap us up here. So, what is the single most important step attendees should take before year end to optimize tax outcomes? And so, John, we'll start with you.
If you own real estate, get an analysis done, estimated, get it to your tax advisor, and then complete a study. You don't need to do the study after the first of the year, as long as you do the study before you file your taxes.
That's good.
Fantastic. Absolutely perfect. Kristen?
I'm going to bring it up one more time, and I feel like I'm beating a dead horse. But most important step, in my personal opinion, would be year end is to get your books and documents straight.
Yeah.
I would love to see everyone make sure they are audit ready. Not just tax ready. We want to be audit ready. Before you're chasing them deductions, you want to make sure your numbers are accurate. You want to make sure they're reconciled, they're supported. Data needs to be cleaned. You need to review that timing opportunities. You need to accelerate any necessary purchases, that qualify for that bonus depreciation that we've been talking about, that deduction. We want to make sure that year-end contributions are done and verify that these estimated payments reflects that OBBA change. It's not, you can't optimize, you have to be accurate. And you have to make sure, like I said, precision at its finest.
Like I said, we should do a campaign, Kristen, about this. But it was the predominant theme and one, like I said, traditional, but resonates so deeply with everybody. Yep. So applauds to you. And so Sly, take it away. What is your one single most important step attendees should take before year end to optimize tax outcomes?
Yeah, the main thing is that for a lot of these strategies, we're running out of time. So you definitely want to act sooner rather than later. In particular, if you're interested in the charitable donation strategy, our team runs a bi-monthly webinar. So that's every other Monday. And the folks at Genius Tax can certainly share that invite with you. But we urge you to join. It's a deep dive with all of our tax experts that goes much more into the strategies. You'll hear about the different products that we offer and the charities and the missions that they're aligned with. So definitely urge you to join one of those upcoming.
Thank you, Sly. And please, absolutely feel free to send that information over. We definitely want our attendees to get more information surrounding that. Thank you. And last but not least, Shy.
Oh, yeah, sure. Book a call with the Genius Tax Advisory because this is the time for you to do it, especially if you're a high net worth individual and you have high income and you don't think you have any opportunities to reduce your tax liability. We still do have time to utilize that, like Sly said. So contact us and really, we can save you a ton of money, a ton of money. So just connect with us as soon as possible.
Thank you, Shy. And like I said, the icing on the cake for GTA. So go team.
Can I throw one
yes,
in there?
Yes,
every one of us threw around, just about everyone threw around Form 3115. A lot of people don't know what it is. It's an IRS Form 3115, change in accounting method, going from straight line depreciation to accelerated. So I'm sorry I didn't explain that before, but anybody didn't know what we were talking about.
No worries, John. And unless if Krishna would like for you to quickly explain about that, Krishna, I think.
No, I'll let Christine explain that better.
Okay.
All right, Christine.
Oh, goodness. Okay. I'm going to let John do it, but thanks, guys, for putting me on the spot. I've done a handful of these, more than a handful of these. I'm actually doing it for one of my clients currently. It relatively just changes the depreciation and gets it all into line. John is a little better at this, and I would rather him explain the 3115 since he does probably more than I do of them. But I I would definitely utilize not, in my opinion, utilize not just CPAs and tax experts. Like myself, I'm a legal person, right? So I would like, look them out, get that legal tax strategy as well, not just on your CPA side or your tax side, but go on top of that and get a legal consultant who handles legal tax strategy like myself at Dickens and Jane, who really deep dives into your tax returns and works with individuals like CSSI or SLY. This is important because we can work with them and really build a beautiful tax portfolio for clients. Not just a Genius Tax, but if you need to go into an actual tax legal realm, contacting Dickens is especially helpful as well. So this is, I'm going to let John explain it better on the 3115. But if you need something deep dived, I would definitely recommend that higher level of a tax legal strategist as well when you're looking at the OBBA deductions. Go ahead,
Yeah,
John.
you're right on, Kristen. I don't know how to explain better than that, but the thing is with us, uh, most of our CPA clients defer to us to do it. It's time consuming, it's difficult. We will do it two different ways. We will prepare it for the CPA signature, or we will prepare it and we will sign it. It's obviously two different fee bases for doing those things, but we do hundreds of those every month. So 3115s, I don't do them. That's we've got specialists that's all they do. We had 1,000 new closings in September. So, having that, there's going to be a good percentage had change of accounting methods in there. Uh, but I turn it over to the pros on my side.
So, okay, I'm gonna go more on an explanation then, since we will get there. So, with the application for changing accounting method, we have clients who are going to have, cash or accrual, right? And most of the time, you're going to, it's either cash to accrual or accrual to cash, right? Improper to proper depreciation methods, old versus new capitalization rules, tangible property regulations or 263A. You're getting changes related to bonus depreciation, cost seg studies as John's specialty is, inventory valuation. So FIFO to LIFO, these are really important. You want, when you're timely filing the 3115 form, it can capture that missed depreciation, or that 179 deduction, via
Right,
the
right, right.
481A adjustment. You're aligning financial reporting with how the OBBA just restored and expanded these provisions. You're avoiding an IRS audit.
Yeah.
I know I continuously depict this, but the audit exposure is immense, and it's voluntary correcting an impermissible method before deduction. You have the possibility of an automatic change, which is the most common business method change. So obviously depreciation capitalization, or you qualify under the revenue procedures and its accessoring. These can be filed with the tax return. So you don't actually need an IRS letter, is needed. So utilize your CPA, utilize the resources that you have, you non-automatic changes, they require that prior IRS consent and filing by the end of the year and payment user fees. So
That's right.
this helps this, you're wanting to make sure that you use this strategically. You want to make sure you fix those capitalizations versus those expense errors. You want to make sure that you're following that regulation
Right.
1263A.
Yeah.
You're wanting to make sure that your inventory simplifications are there. So you're moving to more like a favorable inventory or a unicap method. And we can go on another webinar for unicap method.
Yeah, no,
Yeah.
yeah.
The what you were saying, we get into that also. It's the extension of the cost segregation study. And when you look at a capex reversal, where you're being able to have professionally sorted out what's an expense, what's a capitalization, If you've capitalized it and it should have been expense, you now move it over to the expense, and now you have a tax deduction as an expense line item in there. You do it. So there's
Great.
advantages to making sure that everything is where it's supposed to be. Capitalize, expense, some other functions within there, just like Kristen said. And there's money on the table. A lot of times there's money on the table that you pick up.
Wow.
I do have one more input. I apologize.
It's okay,
This
no
is
worries. Feel free to offer it quick. Or like I
okay.
said,
I'm going to do it really quick because this
yeah,
is for anyone who has M&A and restructuring going on.
please
So
feel free.
businesses that are being reconstructed, I'd highly adopt new software. Make sure you're merging, or if you're merging or you're expanding, it's worth performing the method of accounting diagnostic before year end. That's going to properly be executed on that 3115 and can unlock the deductions and protect against any of these penalties and show good faith compliance. The word is compliance. And, it's a major advantage to today's heightened IRS enforcements. With OPR involved, CID, everything, we want to make sure that you really request that method of accounting diagnostic before year end. If you're doing an M&A, so you're acquiring a firm, you're merging, or you're expanding, please use this method of accounting diagnostic and really look into the 3115.
And with that, Kristen officially wraps us up and drops the mic
Thank
on
you,
such an
Kristen.
incredible webinar. And again, I really want to thank absolutely everybody who joined us today, in our second tax talk, one big beautiful tax talk. And before I do my closing remarks, I would like to once again give the mic over to our CEO, Krishna Mohan, and for him to offer his final thoughts. Krishna?
Thank you, Asen. Yeah, that's a wonderful, session here. I appreciate everybody. Everyone brought tremendous amount of value. I think sometimes it's a little more technical, but everyone gets the point. We are here to help. I think we can cover wide areas, all the way from employee to an exit M&A situation. I know Kristen does a little bit of asset protection and some, estate planning kind of scenarios, and some other scenarios related to charitable trusts and things like that. We can go deep probably in the next session, but all in all, I think we brought as much as we can within this 1 hour. Thank you so much for each and every panelist here, and thank you for everyone here who are joining during this afternoon as attendees. Appreciate everybody's time. We will share this recording, and as I mentioned at the beginning, we are offering free strategy session. Take advantage of it. It is going to literally change everything for you, and we are looking forward to work with you in the future. Thanks a lot.
Thank you, Krishna. And again, I want to say a big thank you to our panelists, John McFarland, Kristen Dickens, Sly Prasuri, Sham Rao, our CEO, Krishna Mohan, for all of their amazing strategies, tactics, practices, and methods. No doubt about it, our audience is truly and forever appreciative and going to be implementing this not only immediately, but in the future. And the big key takeaway, summing up our one big beautiful tax talk, big changes are here, but strategic planning keeps you ahead. So if you have not done so, as repeated by our CEO, please take advantage of our free complimentary discovery call. The link is available in the chat, and you will also receive that along with our post-event survey in your post-event recap email. The recording, again, as mentioned throughout the digital show, will be made available within the coming days so that everybody can watch this again in their own time. And also follow us on LinkedIn. Subscribe to our company quarterly newsletter, The Genius Vision. Our next edition comes out in November. And finally, I would like to offer a very big announcement from the media, from our media side here at Genius Tax Advisory. We are very excited to announce that Genius Visionary will be launching its new signature flagship podcast, Genius Vision Unfiltered. And so we are so excited. It is going to be a new podcast that's going to be putting the focus on founders, CEOs, entrepreneurs, and superstars who have that vision and ready to showcase that through their own story in their own life. It is raw, it is unfiltered, and it is one that certainly it is going to be one for the books, and we are so incredibly excited. Vision Unfiltered will be premiering soon, and if you have not follow and or subscribe to our platforms, now is the time to do so, because we'll be revealing more details surrounding Vision Unfiltered in the coming weeks. And so that I want to thank all of our fellow panelists, to our attendees. Thank you, and we look forward to seeing you again at our next Tax Talk webinar in 2026. Take care, everyone. Till then.
Thank you.
Bye.
Thank you.
To everyone.
Bye-bye.